Good afternoon, everybody. Bill Bodner here. Thanks for tuning in to our Mortgage Market Guide weekly recap. So you can see up on the screen on a Friday, mortgage-backed securities up a little bit, 10-year note moving down in yield. Uh, Obviously, the elephant in the room right now is the Russia-Ukraine story. It has created just a gigantic cloud of uncertainty over the financial markets and clearly driving what they call a safe haven trade where folks just want to get out of risky assets and money goes into the US dollar, the US Treasury market, and then by way some bleeds into the mortgage-backed security market. So we're seeing a wonderful bid in the bond market, and folks, the reality is that story can change, but it's so uncertain. Both sides, all sides, are talking about different things that could happen, and obviously, if it escalates, I think it could be a real bad thing for stocks and probably continue to give interest rates a bid. So we need to be thinking about that. But here at Mortgage Market Guide, what we talked about in our weekly newsletter, our theme is that three reasons why interest rates, at least for the near term, may have peaked. Obviously, one of them is the Russia-Ukraine story, right? This is a highly uncertain, and if it gets worse, and there's fear that oil prices can spike a lot, and if it does, that would slow things down. So that's one big reason why. The other reason is number two: financial conditions have already tightened, right? And if you think about what the Fed, we came into 2022 looking much like 2018, where we had a Fed that was speaking very hawkishly, a desire to hike rates a lot of times, wanting to shrink or sell bonds from its balance sheet, especially mortgage-backed securities. Well, here we are in mid-February, and as bond prices go down, rates go up. This is mortgage-backed securities. You could see it's been pretty darn ugly ever since the Fed flip-flopped on inflation back in November. And so you could make a really good argument that financial conditions have already tightened, certainly in our world. I mean, look no further than housing and mortgage, where you see now mortgage rates up 1% since late 21. And this Wednesday, the National Association of Home Builders reporting that 7 out of 10 people cannot afford a brand new median priced home. It's not getting a lot of airtime, but that report was this week, and the Fed sees that. There's no way the Fed is going to allow housing to just get turned off. I know that the Fed chair got punished last year about why you buying mortgage-backed securities and creating froth in the housing market. Well, that froth, you can argue, is some of that has dissipated, and so that's a second reason why we think rates may have peaked, is that conditions have already tightened. And number three, look at some of the reports. Not everything is going so peachy, right? And what we mean is the big numbers that we watch, and we'll get some reports next week. Consumer sentiment, how people feel, is at an 11-year low. And the number one thing is that consumers are not confident in the direction of the economy. And that's a big statement. And we find it very difficult. I know there's folks out there talking about 7 to 9 rate hikes. We think that is absolute hogwash, so to speak. How can they hike rates that many times when a consumer doesn't feel that good? So we can talk about, the Fed can talk about what they want to do, but then there's a reality of what they can do. And so if the consumer is not feeling good about that, and even the retail sales number that came out of late kind of showed that the increase in retail sales was not necessarily because we purchased more, but because we paid more. There are a lot of cracks in the economy, which will make it, we think, very difficult for the Fed to hike rates aggressively. So, we wouldn't be surprised if in the near term this is a peak. So we're looking at bonds, mortgage-backed securities bounce off of par while we have this uncertain event happening with Ukraine and Russia, and at the same time, we're looking at the 10-year note back off to beneath 195. And so, as a mortgage banker, broker, working credit unions, you're talking to folks, I would be looking at 195 on a 10-year note as like a line. It was a ceiling, keeping a lid on rates for some time. We're trying to get back beneath it. If we get back beneath it, and this story with Ukraine and Russia lingers, it'll put more pressure on the Fed to be able to do more. and it will probably lead to lower rates still. But this story can change very quickly. If there's a resolution and we go back to our corners and it's diplomatic in nature without any kind of human toll, then we're going to get back to the Fed and the data, and it makes it tough for our space. It makes it really, really tough for our space. But bottom line is, this is a bond market trying to find a bottom in price and a peak in yield, and it seems like right here where we get this Russia-Ukraine story, slowdown in some things, and the fact that conditions have already tightened, maybe this is a reason why rates may have peaked in the near term. I hope this finds you well. Listen, next week we have consumer confidence, we have consumer sentiment. That will be further proof if some of what we're sharing here is in place, because obviously the Fed watches that. It isn't just about inflation, and it's not just about maximum employment. GDP and how the consumers feel is a big thing, sentiment. And so we'll see. But have yourself a great weekend. Thanks for tuning in. We'll talk to you soon. Bye for now.